Uh, Okie dokie. So without further ado, I'll on the Prime Minister to open up this presentation. Um,
Maybe like on this side of it.
That's-
It's the better.
that would work out. It's less intimidating for the debater. Community outlet. Oh, brown, let's start.
Is everyone ready? I once had a goggle wallet, and I have many thoughts on it, but I spent some time writing this rhyme. It's so bad it might make you vomit. But first, a bit of framing. So I think that we oppose the use of any of these financial services as provided by large tech giants. So these types of financial services include digital wallets, credit cards, loan offerings, as stated by the info slide. We think quite simply that it would be better if none of these services were provided, if none of them existed. So let's do some characterization of the behavior of these large tech giants. I think quite obviously they're big. They have a massive reach. They're used by like most people every day. Everyone here has probably used Google or like seen or used some sort of Apple product today. Probably used Amazon within the last month. They're incredibly pervasive in their influence in everyday society. Pretty much every single person in in most places around the world has some sort of interaction with these large tech giants. And these types of interactions are often irreplaceable, so there aren't very good substitutes available. There's also a variety of services that these types of giants provides, like Google, obviously research, Apple, a lot of tech products, Amazon just lets you like buy fucking everything. So there's a massive like pervasiveness in how these companies are structured, but also they have a lot of monopolistic tendencies. So what does this actually look like? This means that whenever possible, they engage in buyouts to try and kill their competitors. So Amazon, for example, especially when they were developing, bought out a lot of their competitors or made it incredibly difficult for them to compete, which killed a lot of smaller retailers, for example. There's also a lot of antitrust behavior that these companies engage in. So they try and create environments in which other companies are not able to compete with them. So for example, if like Google has an app that they want you to use, but you are also downloading apps on like the Google App Store, they're going to make that environment such that it unfairly favors the Google types of apps. And even when companies engage in these clearly monopolistic behaviors, it's incredibly difficult to take antitrust action against them because they have incredibly large legal resources. These are types of lawsuits that also take a large amount of time, a large amount of resources, and political willpower from the government to actually effectively prosecute takes many years. So it's not easy to combat these sorts of tendencies, not at this time. So they also try and make their products incompatible through like planned obsolescence. So you can't like navigate across different sorts of environments from different companies. It's also incredibly hard to regulate, and consumers have a lot of access here. So I think that the key thing with this framing is that it means that these companies are able to create environments which is incredibly difficult for other competitors within the field to survive, to operate, to fairly compete for consumers. So when you have these tech giants moving into the financial industry, it means that it's incredibly difficult for normal financial actors to actually compete. The first thing they can't compete on is access to customers. First of all, I think most customers prefer ease of access as opposed to weighing long-term risks. So most people don't spend a whole lot of time navigating like every single possible bank that they could put their money into, especially for the average person that isn't incredibly educated on finances, that just wants access to a credit card or just wants a digital wallet because it's quite easy. They prioritize that ease. And I think that these companies have an unfair advantage in terms of ease, given that you're already indoctrinated into the environments that they have created. So access to customers is incredibly difficult when you have these large tech giants expanding into these spaces. Also, the information that's available to consumers is different because these large tech giants like Google are able to control the types of information that you see based on the searches. They have an unfair advantage in determining what types of information is actually available to customers. So even if you are someone that wants to educate yourself on like the best types of financial instruments to use, it's incredibly difficult to find that information when you're competing with people that literally control the search engines that you're operating on. So it's incredibly difficult for neural banks to compete. Why is it bad that neural banks can't compete? I think this is particularly impactful for smaller banks, credit unions, those sorts of things. I think probably the massive fucking banks that you have in the status quo, they're not going to be a huge difference in whether in their capacity to survive. But for smaller banks, for like credit unions, I think it's incredibly difficult for them to find customers to actually be able to support themselves. It's bad if these banks are not able to support themselves if they fail, first of all, because people already have their money in these banks. It's pretty problematic when these banks then go under when they're not able to support themselves. It has real financial harms on a lot of people that already have their money invested here. But also, it just reduces the options, the availability for people to choose which banks they want to put their money in. Why should consumers care about this? First of all, it enables you to access different types of services. So these smaller banks provide a better savings plan or a better credit card, particularly for the area that you live in. Like maybe it gives you benefits for local businesses. But secondly, it's just yeah, anyways. So I think in the status quo, you probably have a sufficient amount of competition. So the more competition, the more competition you have from these large tech giants, it is unfair where these banks cannot compete on a level playing field. It means that in order to maintain any sort of like customer base, banks in the status quo have to offer riskier services that have higher rewards in order to appeal to more consumers. So you need to give them better better savings rates on their credit cards, or maybe provide different financial instruments that are going to give them better higher returns in the future. But in order to provide these things, you have to take on greater risk, because if you were able to provide these things safely with low risk, you would be doing them already in the status quo. So you push these banks to compete in ways that are not safe for consumers. I think it's also bad if you have less competition in this field, because consumers probably care about where their money is being invested. So a lot of consumers are moving away from large banks, for example, because they don't support the types of Lockheed Martin investments that some banks are making. I think it's probably bad if you have a reduced access to banks that invest in different types of industries based on your individual preferences. I think it's also bad that you have these large companies that have that have a large amount of brand loyalty. People care very much about like being an Apple user. So this type of brand loyalty gives these banks an unfair advantage in this way as well. I think this is particularly problematic for consumer spending, because these products are so easy to access. If you can have your credit card on your phone at any time, if you have it automatically fill in your bank information whenever you buy something, that's incredibly bad, because it increases the ease at which consumers are able to buy things. This increases impulsive spending. It increases the amount at which people are able to take on debt because they have more access to credit cards, which is probably bad for them in the long term, because consumers are often quite bad at managing long-term financial risk. And even just like waiting 5 minutes before you buy something probably changes your decision-making calculus. You might not buy that pair of shoes if you have to like go and find like a real credit card, or if you left your credit card at home and you have to go back home from the mall, as opposed to having your credit card on your phone. So I think this is a massive impact on consumers. Final point then on vulnerabilities. These companies are less stable than banks, particularly given like the political environment of Trump tariffs. This is having bad consequences for Apple, Amazon, to name a few of these companies. Also during crises, I think it's probably bad that your money is tied to a bank that is also going to be suffering in a recession. I think bank runs get instrumentally worse on their side of the house, because if like Apple is already suffering in a recession and then everyone's trying to take their money out of Apple Bank, I think that's incredibly problematic and a lot more of a difficult issue to solve. I think a lot of these companies also changed based on destructive innovation. So who knows if Google will still exist in the future if this brand new innovator comes up with some new product that completely wipes Google out of the market. I think it's bad if your money is invested in that way. It's also bad if you see the increased interdependence. I think there's a lot of security risks, a lot of ripple out effects, if like your bank information gets stolen because your Apple phone is hacked. So proud to.
I thank Speaker for the remarks. Call upon the leader of the opposition to continue this debate here.
Okay, everyone ready? Awesome, let's boogie. 3, 2, 1. Start with some ref. Emma's going to take on a lot more, but I'll get into it first, and then go get into our framing and then our constructive material. So PM talks about how banks, or how these large companies have monopolistic tendencies. I don't think this is applicable in these situations. Most banks that people use on a regular basis are too big for this to work. They are trillion-dollar corporations with massive lobbying entities. So I don't think that they're going to be able to be pushed around in the same way that like Uber was able to like, I don't know, like buy out the taxi industry, or Amazon was able to like get out, outcompete other wholesale resellers. Secondly, they say that like people like ease of access. They have like basically other companies can't compete because these banks will basically just eat up because everyone loves having like an Apple thing on their phone. Note that most people are kind of like baked into their bank. They talk about brand loyalty. People also have brand loyalty to their bank, right? Which means that like, I don't know, I have a TD account because my parents had a TD account and they opened my first account for me. This is the way in which a lot of people get their first banking account. Most people don't really think about which bank they use. They just use the one that their family has always used or that they had an account open for them in. Thirdly, they say during vulnerability, bank runs get worse. I don't think bank runs get substantially worse. I think there's already regulation working against this. I think insofar as the large tech companies are moving into the banking space, the government has built incentive and capacity to regulate. For that, and that moves really easily into our frame. I want to point out two types of things that we're talking about in this debate. First, the ability of these large tech corporations to facilitate financial transactions, right? In the type that still need banks. So things like Apple Pay, Apple Card, which is issued by Goldman Sachs, Google Wallet, right? So insofar as this is true, you also need another bank to do this. So I think a lot of their first impact doesn't matter. But secondly, if you're engaging in commercial and investment banking itself, this is the second option, and we think we apply to both. So as soon as you actually begin engaging in financial services and banking, whichever, regulations kick in. The governments broadly have both incentive to regulate this type of behavior, because if consumers are hurt and politicians don't regulate these banks, then politicians are going to feel the pain. See, like Republicans in 2008 getting absolutely eviscerated for a massive financial calamity that happened on their watch because of the underregulation of banks. So politicians have incentive to regulate. And two, they have the capacity to regulate because the government is literally like the largest entity in the country. It has the most incentive and capacity to regulate. So with that being said, what is our constructive? First, we're going to clash directly on convenience. We think that the integration between services means that the quality of those services actively gets better. So we think this means things like, I don't know, if you're buying things on your phone, it's probably actually a little bit better, particularly for people like particularly for people even who have like disabilities, to be able to like access and facilitate accessible like transactions and have that between services. So if if your credit card is on your phone, that's one less thing that you need to do. So we think overspending might be a problem. I don't know, skill issue. I don't know how big of an impact this is in this round. I think largely we think accessibility is good. We also think it's probably good for businesses to be able to integrate better between their platforms. If you're selling something on Amazon and you also have like an Amazon bank, it probably just means there are lower transaction fees, things like this. That means businesses are better able to compete. Secondly, we think for consumers, this is also better because banks don't give you like notifications, or at least my bank doesn't, like on your phone when something happens. But if you pay with Apple Pay, I get a direct notification every time. We think this is the thing that these tech companies are able to do when the company that runs your phone is also the company that like helps facilitate those transactions. We think this is actually beneficial for spending practices, but also important for fraud, right? Because if you see a bunch of transactions happening on your account, it doesn't mean you have to go to the app on your phone. Your phone will tell you itself. Okay, I'll take it later. So secondly, we'll talk about competition. So we think this forces banks to adapt to a changing world. The problem is in status quo, banking is lethargic. It moves at the speed of like a snail, right? Which means it can't adapt quickly because there's layers of bureaucracy. You have to constantly like be pushing for changes. People are baked into the systems that they have in place, which means you need to be able to adapt to offer better services. We think it's better for consumers to have greater competition in the banking environment. That means these trillion-dollar corporations actually have to get off their ass and start innovating, which also means you get like things like lower transaction fees. You get more modernization of banking industry in general. You probably get better like protections for people's data, etc. Because Apple and Google are going to be massive actors in this field, and they have better access to kind of data privacy software. Thirdly, for innovation, this kind of ties into the previous point, but we just think you also get better innovation in the banking sector. And we think largely this is probably just better for consumers if companies are incentivized to compete against each other, offer consumers comparatively better and better services, and are incentivized to innovate to create more services going into the future. We think that this ultimately means that consumers probably save more money, they have better banking practices, and that this leads to better financial stability in the medium to long term. Now let's talk about stability, because during times of economic crisis, take it.
So why is it that these massive firms that can, like acquire smaller firms are actually going to bring any of these competition benefits?
Because the firms that they're competing against are also really large firms. So it's not like maybe the small firms get harmed. I'm not actually sure why these small firms are good or why people should be going into these small firms. I think in times of crisis, like PM talked about, bank runs for small firms probably means that those small firms get crushed. We think that people should probably be putting their money into large firms that have greater financial stability. Things like, but also things like the FDIC, like kick in, where people's like, what's it called? What people put in banks is insured up to like $250,000 in the US, stuff like that. But we think during times of economic crisis, this matters a lot, right? We think insofar as people are able to put their money into a bank that is headed by like $1 trillion corporation that's never going to go down, regardless of how bad things go. We think that this probably means that your money is safer, especially in times of crisis when you need it to be safer. And on that same theme of safety, we think this is also actually better for data privacy. We think gov theme throughout this debate is they're going to argue that it's actually bad for these companies to have access to your data. First, we think that as PM frames, a lot of these companies have access to your data anyway. If you're already buying things through Amazon, if you're already using an Apple phone, they probably already have access to your data. What the difference is that other actors now have a much more difficult time stealing your data that is otherwise held in banks. Why is this true? Because these private corporations, one, are massive in data privacy. They don't want their information stolen by other firms, which means they have to hire the best. They have to pay the best wages, pay the highest salaries to get the best workers to work in these industries, which means that, or to work for these corporations, which means that stealing data, having your social security number leaked, having access to your banking leaked, which happens like pretty regularly for traditional banking firms, is less likely to happen on our side of the house, which means you're less likely to suffer the consequences of having massive data privacy breaches for these firms in comparison to regular banks. So we think the weighing on this debate is very clear. One, we think convenience, if anything, is a win for us, but is probably maybe a wash. But we think that one, this incentivizes better competition and innovation. Two, this is better for stability. And three, we think it's broadly better for data privacy in general. Because we win on all three, we believe we win. Thank you.
I thank the speaker for the remarks. Call upon the Deputy Prime Minister to continue space here.
Oh,
No. Okay, just want to check everyone on the computer can hear me okay if I speak at this volume.
Yeah, you good.
Sweet. Awesome, thanks. All right. Oh yeah, CO. Just to know, I really don't like verbal POIs. So if you wanna like give a emoji or whatever feels good on the computer, I'll happily take you, but please don't unmute if you can avoid that. Okay, cool. I'm gonna start my test in 3, 2, 1. If I had got a BlackBerry wallet instead of a Goggle wallet, I would be super fucked right now because BlackBerry basically irrelevant now. I think the destructive innovation that you've talked about completely unaddressed by opening opposition still really matters. I'm gonna talk about a whole bunch of other things that also matter. Let's get right into it. Okay, the idea of why the monopolistic force matters. I think it's obviously not true that Apple's gonna like buy out like CIBC, but I think the problem is that what Apple probably does is makes it really hard to like the government. This is part of why it's really hard for the government to regulate things like Apple. I'm going to talk more about regulation in a second, but I just want to flag that they misunderstood what we mean by like monopolistic forces. Obviously, no one's saying they're going to buy out TV. All right. The idea that people are baked into their bank. This is exactly the problem. I think this means that this proves the mechanism that Eve gives you, which is that most people prioritize ease over actually making just financial decisions. They don't actually think like, oh, is TD better for me than CIBC? They just stick with what is easy for them. When you change the delta on ease, when it's like, oh, you can't access CIBC on your phone anymore, you have to go through Apple to have them on the digital wallet, then people are making decisions based on that then lead them to make, therefore, worse financial decisions in that way. I think Eve has already told you how most like large financial institutions like banks make kind of generally like a range of products that are fairly similar, right? There's not a massive difference between banking with TD or CIBC. But now, in order to have this competitive advantage, Apple's probably doing things like making worse, they have less expertise, they're making worse decisions, etc. But also, you now encourage smaller institutions like maybe you work with Service to make worse choices. So I think because consumers are bad at making choices based on actual financial benefit to them, by changing the way you make their choices towards ease in terms of worse options, that hurts them. That's really important. All right, let's talk about regulation, because basically I think a big push from OO is it's going to be fine because we're going to regulate it, guys. It's going to be totally chill. Eve already gives you a bunch of reasons why regulation is not possible. I'm going to give you a bunch more. First of all, it's just incredibly slow, like especially for new tech. Like guys, most people in the US Congress are fucking 75 plus years old. They do not know how tech works. It takes them forever to understand. Like they asked the guy of TikTok if he like knows what like TikTok is, like or how it's connected to the internet. Like they don't fucking know what they're doing in terms of regulating tech. It's insane, right? It also just takes a lot of time to work through these things, even if there were like experts in Congress. Secondly, a lot of things are actually technically legal and you sign on to them through like tech things, through like a million terms and conditions that no one ever could fucking read, right? Like there's a lot of loopholes here, especially because three, these companies have massive lobbying power and incredible legal teams. Like they probably own half of the fucking US Congress already anyway, and they have the ability to do things like bake things in terms and conditions that then make it very hard to regulate them. I think if they're going to rely on
regulation on off, they're gonna have a very hard time. It's obviously very hard to regulate these things. All right, quality of services being better. I think we just tell you that overspending is a massive issue. They just wave this off. I think that's like crazy. Like literally the amount of money I have spent on my fucking digital wallet, like I can just attest to you. Gut check it. You've all probably been like, fuck, I shouldn't have pulled out my phone. If I had to at least like pull out my wallet and like look at my credit card in real life, I think there is some margin there that matters. Emma literally was like, that's so true when I was saying it. So don't buy this. I'm just gonna tell you it's not true. It's totally true. But even if you do not buy this, I think that is massively outweighed by vulnerabilities. I'm going to talk more about this on data privacy, but I think that like even if you can see like that like sure there's like some amount of better services, i.e. it's like easier to pull out your phone, I think vulnerability is much more important. I'll get to that in a second. Okay, notifications about fraud. Bro, like sign up for the email notifications. I don't know if this is going to be the delta in the debate. Like if your phone's not currently telling you about your bank, that's crazy. But also, much worse than this is what Eve tells you, which is that maybe now when you go to Google, it is Google's highly incentivized to deprioritize information about the Google fraud that happened in their fucking bank. And because that's probably your number one source of information about banking in like the world, that's probably really bad. When we tie incentives of like things that provide us information with things that access our banking information, that's probably not good. They didn't address that. All right, basically the whole kind of rest of their push is like flexibility, like adapting is good, competition good, etc. First of all, I think Eve already tells you that the way traditional banks operate is like, yeah, sure, it's like a little slow and not like making random new shit all the time. That's because it's designed to deprioritize risk and make sure you're not making like crazy decisions with your money. This is probably good. I think new movers in the like financial space probably have things like less expertise, less experience with just like how to manage a financial institution. This means they're potentially making bad choices, like giving people credit who probably shouldn't have credit, that kind of thing that is probably going to hurt people ultimately. All right, let's talk about data privacy. I think really importantly, two things. First of all, you are inherently just doubling your exposure by having something like a digital wallet. Now, your banking information exists in your phone and in your bank. So if you're a hacker, you can just take your pick of whichever one of those is easy to get into. You've immediately doubled your exposure. But I think if you consolidate all of your financial information within your like one company, like maybe you have your Apple like credit card and all your Apple stuff is on your iPhone, you also have just doubled the risk of that like one thing. So either way you're doing it, now either it's like a much more juicy target if you can hack into someone's phone and access literally everything about them, their entire like banking infrastructure and also all their phone stuff, or it exists in multiple places and you've doubled your exposure. I think in either case, data privacy is a massive issue. Apple loves to say they're like the king of encryption and stuff, but this is like very much not true anymore. Like they have actually made massive sacrifices on privacy. They've been willing to like sell like things to like the Chinese government and stuff under like different like legal orders and stuff. There's a whole thing in the US where the US government was like, you have to like unlock this phone for us, and they did it. I think Apple has lost their reputation for privacy. It's no longer reliable as a thing that can help preserve your privacy. Have to take a few from back half if you have one, and if not, we'll go for it.
No, we good.
Okay, cool. Frenna? No, we're chilling? Okay, sweet. Love it. Awesome. Okay, what did he talk to you about that's really, really important still? I think crucially, the kinds of decisions consumers make about their finances are usually just not great. Like, honestly, same, I get it, but we cannot rely on consumers to just like, we can't just say like competition good because consumers will make good choices. This is just not true in a financial ecosystem. The problem is now you have things that impact those decisions like brand loyalty. Like, I think we should not underestimate the Apple bros and how much they will ride or die for Apple and get this like dumb Apple credit card, even though it's probably bad for them. But even if it's not a conscious choice of brand loyalty, it's integration. Like, I can't even like get messages from my aunt who has iMessage on my Google Pixel, and it's really annoying in my family. And like, so probably if my credit card doesn't even work only on my phone and I have to get a different phone, I'm not going to do that. I'm going to end up with probably a worse deal because the criteria upon which I'm making financial decisions is now the integration of my tech that I already have instead of like the credit, like the interest rate and stuff that actually should matter. So consumers are now hit with things like overspending, potentially just worse conditions, and we cannot rely on competition as a net on opposite side. That's really, really important. This means competition is not inherently good, especially because some of the competition that will happen, like Eve tells you, is convincing smaller banks to make worse, riskier decisions, and that's probably bad. Last thing, just like volatility of these companies, like again, like the BlackBerry wallet would have been a terrible fucking investment because some of these companies, due to the nature of them innovating, means that innovation always means risk. Sometimes they fucking die, and that would be really bad. Really proud.
Something I think speak their video. Hey, you're here. Back in my computer is broken.
I'm so pain. I know it like kind of comes in and out of like I blend into the background, like of the whiteboard. I was like, damn.
Can't believe you used my name again.
Wait, that was a problem for me.
Got him. Are we good? No.
30 more seconds.
Okay.
Yes,
I just don't know think anymore.
It's a word flash.
It's not a work laptop. This can make my life more difficult. I still haven't gotten Bluetooth working on this laptop. Okay, it's not meant to be right.
My time will start in 3, 2, 1. I think opening government suffers from a lack of illustration. They say worse decisions end up getting made. I do not know what these decisions are, other than making it other than just making a purchase like quickly because you have access to your card. But any of the other things they talk about, i.e., banks doing riskier things, I don't know what any of these actually are and what they look like. I'm unclear to the extent to which banks are incentivized to do things that fuck over their consumers at the point at which they're trying to compete and trying to gain loyalty. I think more reasonably, the fact that the things that the banks are going to do is because of competition, because they have to innovate to be able to gain consistent access to their customer base, or likely going to do things like offer better quality of customer service. They're like going to offer lower fees. They're likely going to make things easier for their consumers, which is probably something that is quite good because a lot of people are quite loyal to their banks, but their banks don't treat them very well or are not very accessible, right? Like I'll call TD and I'm on hold for like 2 fucking hours because it's really shitty. If I can just go to Apple, something that's much more convenient, I would probably, TD is probably much more incentivized to become better, right? We think in status quo, these banks have a historical monopoly and such that they are like, because they're like shitty and slow, but there's no one else fighting against them and people are like loyal to them, they're probably just gonna like fucking stay there and like have to continue suffering. Also, they say, oh, set up email notifications. I think that's like not necessarily like, I don't know, man. My fucking credit card wasn't working recently and I had to call the bank and be on hold for 30 minutes just to find out there was a freeze on my credit card. Like, I think that it's the ability to access financial information on your phone, having that integrated is something that is extremely important, especially if you lack financial literacy or you lack the time and resources to be able to like dealing with these things on a high level. I think this is a big stressor for individuals that's probably built better. Let's then talk about the point about like data privacy and data encryption, because I think this is the strongest point we get out of opening up. First of all, I think that the fact of the matter is both Apple and Google are at the very forefront of the development of this type of technology, right? Note that the technology that banks are using to do data encryption is probably developed by these tech giants to begin with, right? As Rob characterizes to you, they just hire the best and most experienced people, the most intelligent and well-educated people who are at the forefront of innovation, which means it's much more likely that they have a much more integrated data encryption process. Them saying like a few examples of like Apple did something to China is not enough analysis to sufficiently prove to me why it is that these companies that have such incentives to have such strong encryption capabilities are going to be harmful. They say, oh, but the company might like die, i.e. like why shouldn't they get the BlackBerry wallet? BlackBerry is like a reasonable comparative, right? BlackBerry was nowhere near as big as Apple or Google. They had nowhere near the like amount of time of existence and the extent to which reach. Obviously, BlackBerry never fucking created a wallet or expanded because it only had a certain niche in its market. It was also competing to a certain extent. We think at the point at which, no, thank you. At the point at which Apple and Google are entering into these industries, they know it's because they have a lot of money and a lot of capability to be able to do so in a way that is not going to burn them out, that is not going to fail, given the extent to which they are very like important within the market globally. I also think like government probably so unlikely to let that happen, given how much both Google and Apple are integrated into the ways in which we like exist like in like e-commerce and like I don't know, like in business globally, right? But why do I just not buy like they're like, I don't know. Do you feel
Why is there insufficient competition between banks in the status quo?
Because banks are, okay, the issue is that in status quo, all banks are just kind of shitty and not convenient, right? I think also, like, this is also like, at the same point, you're like, oh, the monopoly is bad. Like, how is the monopoly any different on their side of the house? The reason that, sorry. The insufficient competition exists because all banks equally suffer from a lack of innovation and technological advancement. This specific competition is new and different because it is better and more convenient and consumers are actually being drawn to it. This means that even if there is supposed insufficient competition, if you have competition that leads to just better quality of life in terms of individuals being able to access their finances and businesses being able to better integrate themselves, this is probably just a net good in terms of in terms of both people and companies' ability to like access their finances, get better services, things like that. These are all things that that are probably important. Why then is it like good if you can have access to your money quicker? Because you can donate to charity without thinking too hard about it. Like, I think there are a lot of times when it's like, oh, it's actually quite annoying or quite frustrating if I can't get my credit card in time, if I don't have things ready. Like, i.e., you're trying to buy concert tickets and you're fucking like scrambling to find your card and like the time is running out, right? I think there's a lot of scenarios in which this convenience is quite important and like meaningfully improves the quality of life of individuals. And I think the simplicity of it is something that is quite beneficial because a lot of people who don't have financial literacy are getting a lot greater, a much higher degree of access to getting a more base level understanding of like how they can access their banking and how they can do that. Yeah, but point being, I'll take that, actually.
On this data privacy thing, you just flagged to us that these corporations, these banks, are using the same encryption technology as the tech corporations. I just don't understand why data privacy is all a margin in this debate.
I don't know, man, that's the OG's case. Like, I don't necessarily think data privacy is extremely better, but it's probably better to a certain like marginal degree on our side of the house. Point being, they're using the fucking watered down version that Apple sells to them. Apple probably has the special secret version that they keep just for themselves because they want to maintain their competitive advantage in the scope of data privacy within the banking industry, right? I think that the extent to which we get expertise on our side of the house is better, right? They also argue that like, oh, these like, because it's not a bank, like they probably don't have like, they're probably gonna make worse decisions. Once again, no clue what these decisions are. But like, I also just think it's quite likely that these, like when they expand into banking, they're going to hire experts in the field with experience in banking and know who know what good banking decisions are and the types of investments that like should be made, right? I think it's unclear and unlikely that the competition that is created as a result of this is going to be something that is like permissive or bad, i.e. like forcing consumers to have riskier investments. Why? Because consumers just won't opt into doing riskier investments, right? I don't think like I just don't see why in status quo like banks are like wouldn't be incentive, like if the banks are going to make so much money off of this or they're going to have a better like outcome of this, why they wouldn't already be doing this, right? I think to a certain extent that like then let's I guess talk about regulation, right? Because they say, oh, you can't regulate because it's like super slow for tech and the fucking like senators are old as fuck. First of all, regulators are not legislators, right? Regulators are individuals who are in the field, probably have a lot of experience in it. They're probably very quick to follow development. Also notice that existing regulation can be cross-applied for like technological advancement. In order for Apple to create a bank and become like existent in the fucking like global stage of like, I don't know, the banking, I don't know the words for it. They have to go through certain processes of like fucking like oversight and like due diligence, but to the point at which they are able to create themselves. Any new technological advancement they do, they probably have to go through a high degree of like testing and like clarification before they do that. The reason that banks in status quo, and note that I worked at a bank this summer and the fucking technology was ass, I was like RBC lock in, is because they have so much more limitations because they are historically intertwined and like just like so much more bureaucratic and have less degree of like access to technological innovation, given that most of the technological innovators who are the best are working at Apple and Google. Because of that, Apple and Google are more able to like adjust to the market at a quicker way and make products and services that are really good for people to be able to access, which is probably quite good. And at the point at which banks have to compete with them on this, they're probably likely going to hire more people like that, innovate in a better way, or just like do things like offer better customer service, do things like change the ways in which they like are less predatory to consumers, or like offer things like lower interest on loans. These are all things that create a better market for individuals and like a better banking experience. Brad too. Yeah.
I think the governor, upon the member of government to open up feedback.
This is like kind of distracting, TBH.
Just ran
Just yell
out.
loud. Right? I didn't hear it.
Argument. No, don't start.
Feeling calm.
I'm gonna passionately think.
So loud.
The top half in this debate has rested on a characterization of what the consumer financial market looks like that I think is kind of ridiculous. It's about like the frictional differences between having to like pull a physical credit card out of your wallet versus like tap your phone, and whether that leads to like actual real differences. It says the comparative is small credit unions that frankly probably like have issues with data privacy and like antiquated software and like are quite inconvenient for their customers. What we're going to do for you on CG is simple. First, we're going to explain why on the counterfactual you have much more important consumer innovation that leads to people having like more seamless and more clear interactions with the financial system that favor them. And second, we're going to explain why it is that it just doesn't make sense for tech companies and banks to merge together. Why you end up with like a mid bank and a mid tech company instead of when separately they could be a good tech company and a good bank. First argument then on why you have more innovation on the counterfactual. The first thing I want to characterize here is that financial innovation is obviously good for consumers for a lot of the reasons that OO gives in this debate. For example, if your credit card is integrated with your cell phone and you can like pay all of that in one bill, people are more likely to pay off their credit cards on time. Benefits like fraud detection, etc., are much better if everything is integrated. And I want to also characterize that the type of innovation that happens from tech firms doing this is unique from what you get from legacy banks. So for example, if you look at what like banks like Morgan Stanley or Goldman Sachs have done, they have done things like offer the built credit card that like gives you points for paying your rent with your credit card, but they have done very, very little to like improve, like consumer innovation. Like they haven't come out with wallets that you can use on your phone. Like their fraud detection services are massively lagging. They'll like maybe send you an email, but I think these things are just broadly inferior. The types of innovation that happen are quite different, whereas tech companies tend to focus on like actually giving financial integration onto like the tech platforms that people use already, obviously because that's the space that they're actually in. I think that generally we are going to have a lot more competition on our side when you do not have like tech firms, massive tech firms entering into this space. Why is that? First, I think that startups or small firms are just massively harmed by the expansion of big tech firms into this space. Because if you have an idea and you go to like a VC or an investor to try to get capital to actually have your startup, they're going to not want to help you out. Why is that? First, because if Google is already working on a similar project, it becomes completely unviable for you to actually be able to compete with them because you don't have access to the same quality of engineers. Even if you get tons and tons of money backing them, you're never going to have the resources that Google has. So they're always going to have a better product than you or something that they can offer more cheaply or something they can integrate onto their pre-existing networks, etc., which deters investors. But second, even if the legacy tech firms are not operating within this space already. So even if Google has no project or Apple like hasn't touched this, the odds that they will either just copy your product when you release it onto their market by saying like, yeah, I think that having, the option to like put all of your expenses, like your cell phone bill, your app store payments, your credit card on one bill is like a great thing. And we're just going to steal this and integrate it onto our existing platform. Look like what Meta did with Snapchat and just like stealing stories. So even if you have the time advantage and you're the first mover, your idea can just get stolen and it will probably be executed better than you can because of the massive resources that these companies have access to. I think that all of this means is that you do not have small firms or innovators being able to enter the space and provide competitive products. Why is it that in the counterfactual, I think this is likely to happen? The first is just that demand for a lot of these things does exist, right? Like people do want to pay for things with their phones. People do want to like have a more seamless interaction with the financial system. Lots of people do like find the current status surrounding, like payments and stuff confusing. They find it annoying that like they have their bank with one institution and then like their credit card is in a secondary location, etc. So I think there is consumer demand for this and people do want to buy these things. But I also think that you have, it's just now viable to actually start these firms to invest in startups that want to disrupt the space because their odds to success are much higher. They're not going to get like swallowed up and walloped by Apple, for example. And I also think uniquely the type of innovation that you get from these firms operating is a lot better. So note that monopolies, i.e. Google, have minimal incentives to actually innovate because you have the consumers already. And also they're sticky because of the nature of how finance works. It's like annoying to close your credit card and start a new one, for example, or like loans are on 5-year terms, etc. So once these mega tech companies have already absorbed the consumers, they don't really have to do anything to keep them around because they literally have contracts already. I think that when they don't enter into this space at all, you have more incentives to innovate because there's more competition between firms. You don't have the same monopolies here. And I think this competition is generally just good. The weighing here is that OG says that the counterfactual is things like small credit unions. These are also quite bad for people. They're inconvenient. They're more antiquated in terms of their software. They don't do things like innovate. We prove why comparative is better and we should co-opt the innovation benefits that OO gives you for why consumers are benefited. But yeah, sure, I'll take opening before I go on.
Yeah, so legacy banks are also absolutely massive firms that also don't want startups stealing their companies. Why don't the startups just get walloped in the same way by these legacy firms?
Because the quality of like software engineer that works at like Morgan Stanley is way, way worse than the quality of software engineer that works at Google, for example. Like they don't have the capacity to actually do these types of financial innovation. And also, as I'm going to get to in the second part of this extension, because of like the way that legacy banks are structured and the much more stringent rules that they have to adhere to, they can't take massive risks and like invest in products that are going to be competitive. So they are not able to compete with startups in this space the same way tech companies that have higher risk appetites actually can. That brings me to the second part of this extension, which is that tech and banks do not integrate well organizationally. The first reason for this is simple. It's that banks are much more highly regulated. They have things like rules about how much they have to keep on their balance sheet, what types of assets they're allowed to hold, legal departments, like information that can't be shared between departments, et cetera. And there's just massive administrative costs associated with this, but also hamstrings your ability to take risks in a lot of ways, which is why legacy banks don't do much financial innovation, as we can see in the status quo. And I think this just does not work well with tech companies that often rely on doing things like being able to invest massive amounts of money in an AI project that like might pan out in 15 years. And you have much less tech innovation happening with these firms. The second is just there's just managerial disagreement about risk taking. Like the people who come from the banking sector that now run the banking part of these tech firms and the people who are on the tech side are like not going to agree about what products they want to take on. There's going to be friction. It's going to be bad for these companies' share prices. It's going to be bad for the actual decisions that get made. And I think also you end up not being able to fund tech as much once you have an established bank because there's like a time scale here, right? So you can't do the innovation once you have a big bank because these regulations are in place. There's also just shareholder disagreement when you have like some people that bought your share because they wanted to like have a tech firm and some that wanted it because of the banking sector. And this leads to friction, like your shareholders take you to court. It creates costs for these companies that are generally bad. I think the impacts here is that you have a bad bank that is bad for its consumers, and you have a bad tech firm that isn't actually engaging in much innovation anymore, versus if these firms are just separate, you could have a good bank and a good tech firm. How to propose.
I can vote on the member of opposition to continue this debate here, Mayor.
Okay. Hi, can I be heard?
Yeah,
Could you like turn me towards the government side so I can see POIs? Yeah, that would be great. I don't need to see OO. OO's not POIing me. Okay. Cool. Yeah, I'll probably take a POI from opening around 5 minutes. Okay. Starting in 3, 2, 1. We will just run competition better than opening opposition. I think opening government has a lot of questions about why, for example, competition does not currently exist within the status quo, which we will particularly answer. Afterwards, I'll do refutation against the closing government case. So first of all, opening opposition essentially says throughout their case, the presence of these tech companies forces other large banks to compete by providing better services and resources. First of all, I have a very limited understanding of why these services or resources are necessary at this point in time and who specifically it impacts. But second of all, why these banks do not currently innovate in the status quo. So the first question I'm going to ask is why there is a lack of competition right now going beyond the opening opposition assertion. I have 5 different mechanisms here. First of all, people want to feel relatively secure with their investments. When we're talking about finances, the opening government characterization is wrong. People don't want ease of access. They want to know that their money is going to grow. They want to know that they have a stable pension, for example, or that they can, for example, support their kids when they're older. And what this indicates to us is that people generally put their money within specific banks at one given time and do not want to touch that money in general because there are narratives that you need to let that money grow, or for example, you need to invest in things like riskier investment decisions over a long period of time and not move that income between banks very frequently. So in general, people have an incentive to securitize within very specific large banks. Second of all, there's no appeal to small banks within this debate. Like within PM, we hear the idea that, oh, like local banks can maybe compete because they provide like local businesses some sort of benefits, which I don't really think is the proper characterization within this round. Again, as we already framed, most people want to go to banks because they want return on investment. They want to feel secure with their money. And therefore, small banks don't have some like artisanal benefit of like, yes, we're like the small bank who can locally provide to their needs, because most people are just functionally wanting more money in the status quo. Third of all, people want to focus on putting money in the same banks because within family units, it facilitates easier access of, for example, cross like trade of funds. Like, for example, my mom wanted to transfer my RESP money from like Tangerine Bank to like TD Bank, where I currently have my bank account. There's huge issues with this. First of all, because banks have competition to not move money between different bank accounts. And so they all want to set up barriers of entry to, for example, make it easy to access different banks or make it easy to move between different banks. But second, and more importantly, the fucking government wants to always tax you with every single transfer that you ever make so that the government can be functionally richer, which is why most people will leave their money within few specific banks and tell their friends and family to leave money within specific banks, and that leads to the consolidation of these industries. Finally, there's just a high degree of elitism within this debate. Like, most people, even though they care very deeply about their finances, this is not a contradiction, do not feel adequately like they have the knowledge to, for example, know about those finances. And what this means is that they blindly trust other people within the bank who have incentives to lie to you to, for example, keep your money within specific banks. Like, this is the literal reason why subprime mortgages and the 2008 financial crisis was able to occur, because people do not understand the scale to which they understand financial knowledge. And most importantly, they defer to other people and financial advisors within their bank to consolidate that money within the industry. What this indicates to us most critically is that most banks will feel relatively secure that the consumers that they currently have will stay with them. People are very, very unlikely to move money between different banks. And what this means is that large banks are relatively well consolidated in terms of their industry. That fills in the opening opposition gap beyond an assertion for why it is the case that competition does not currently exist within the status quo. Second of all, what are the actual benefits of this motion? The first thing that I want to do is provide two vulnerable actors within this debate who actually need, for example, these financial services. First of all, most people within late stage capitalism are facing rising prices. Like, the average rent price is 1/3 of someone's income. That is greater than during the Great Depression. People need financial flexibility right now. They need to be able to readily access loans, for example. And the only way that you get that, by the way, is when large tech companies, who, by the way, make, yes, a lot of money, are relatively well consolidated and probably have higher amounts of money in order to keep like floating cash within like their systems, or for example, lend out relatively riskier loans to other people because they're not worried about those people defaulting necessarily. That is beneficial towards those people in terms of providing additional financial flexibility. I think opening government asserts within this debate that people are like overspending and financially irresponsible. I don't know, this is like a pretty high bar to prove. Like, I think most people in general like care very deeply about their money and probably want to do the things that are best in order to like not spend on like random financial purchase that is not necessary for them. Second of all, people within developing countries or rural areas who might, for example, have access to technology as framed by opening government, but don't have access to a brick and mortar bank, it's incredibly important that innovation particularly occurs on online platforms so we can have decentralized access towards loans, decentralized access towards savings, decentralized access towards your finances. And those are the two actors within this debate that are actually important. The final thing that I'll do is respond to the opening government mech about competition, but before that, I'll take the POI from opening gov.
Okay, so if you've proven why competition is not sufficient even with a large number of banks, why does more banks give you good competition when they're engaged in anti-competitive practices?
The reason why this is the case is, first of all, because these tech firms are not relatively well consolidated within the industry, the banking industry right now, even if they're consolidated within the tech industry. And that means that they have to do other things in order to, for example, make people come on. And that is particularly empowering my mechanisms about all of the things that I said before about how people want to, for example, stay with the same bank right now. That means additional tech firms have to provide lower interest rates on loans, have to provide additional financial advising. These are things that are necessary for these tech firms to do. Really quickly, I'll respond to the closing government case. First of all, the closing government case is on the margins of like firms getting bought out or startup firms who want to innovate getting bought out by tech companies. Well, like, first of all, the opening opposition POI is sufficient. These are multi-trillion-dollar banks. Like, they can hire software engineers if they really want. But second of all, most small businesses cannot innovate in these spaces because it's incredibly costly to, for example, innovate on, for example, like financial services or technological services where you have literal software engineers from Google competing with them. Second of all, they say that we're just going to get like mid-banks and mid-tech companies. The parallel analysis to this is no. Tech companies can cross-fund, for example, the stability that they get from income and revenue in their tech spaces into, for example, supporting things like riskier loans or financial flexibility or more innovation within these spaces. For all of those reasons, we're very, very proud to oppose.
Brilliant. I thank the remarks. Call upon the government. Here.
I'm so mad.
Absolute gas. Yeah, buttery up and then definitely not.
Dang, worth a try.
I tried. Okay. I don't do that. I might go. Oh shit. Walked out.
You need this.
No, it's fine. Okay.
Walked out, like, soon.
Nope, nope, nope. Bad.
Or not.
I'm gonna be very clear about something at the top of this speech. The reality of these tech companies is that they often enter markets with huge innovation that seems quite good to a lot of people. And then once they're there and they're established, they stagnate and they block out any future innovation and they don't lead to good improvements into the long run. Our case is quite simple. We do a much better job in opening government of explaining what the counterfactual is and explaining why, not just initially when they're entering the market, they're going to like compete with like Van City and other credit unions, but they're actually going to, into the long run, make sure that nobody else is able to innovate and compete and step into the market. And then secondly, we explain why both on the tech front and on the financial front, they're going to do much worse than a counterfactual, which is just, again, somebody is a bank and somebody is a tech company. So the responses that we get to the first part, which is about why it's the case that we get more innovation, why it's the case we get more innovation counterfactually. The first claim is just, why don't legacy banks wallet them? Serena explains in her speech why it's the case that these legacy banks have a harder time innovating. They, one, have a harder time accessing software engineers by the same mex as OO says they struggle with data privacy. But also more importantly, they really struggle because they have a lower risk tolerance. These big tech companies or these small companies that are like using VC to try and innovate in the space. This means that the legacy banks aren't going to try and outcompete or aren't going to be able to wallet these new innovators because they are unable to do it. They sort of want them to exist in a way that Google and Apple don't. And the second claim that we get is just that, it's expensive to innovate, so nobody's going to do it. The reality is there's obviously an enormous demand for this innovation to happen. And so this will create the incentive to innovate into the future. This will create funding through VCs and other investment mechanisms. And even if it's somewhat slower, we think that's preferable to it happening like very quickly and then completely plateauing. The counterfactual then is just one where instead of these big tech companies coming in and then making sure that no innovation happens once they're there, because they can just keep cranking out the same iPhone over and over again, but they add a number and now it's cooler. What actually happens is that there is more startups and more innovation in the space that even if it gets swallowed up by the big legacy banks, is then incorporated into making the legacy banks better. This is more important than what OG offers about like competing with small firms, because it explains not just why when they're entering the market, they're going to compete again with these small firms that were sort of unclear or even good, but why they uniquely beat out what's most important in this round, which is innovation that would come from like startups going into the future, but also because of this characterization of the fact that once these tech companies are established, they no longer have an incentive to innovate, unlike new firms who are trying to get in, who would now be blocked out. The second part of the claim then is just that there's a huge organizational struggle. There's a reason, status quo, most companies do one thing and not two things. And I hope this is somewhat intuitive, but the reality of the situation is that whenever you create these managerial tensions, like imagine Amazon has to make these trade-offs where it's like, should we provide loans to people who don't have our third Prime subscription? Well, obviously, there are different incentives here, and this is a facetious example. You can imagine the instances in which this creates tension in the way that these two products are managed, and they have to make trade-offs between the two of them. But also, there's just a huge amount of bureaucratic bloat, which is bad for consumers because it means that prices are higher, it means that things are slower to come out, it means that you're going to get worse products both in the tech sector and in the finance sector, which is unique in a way from when they would just be two separate companies who both have as much of an incentive as they do to innovate. Sure.
Can you give me an example of like banking innovation that's been like a caused by a startup in status quo, which is what you're arguing?
I can't. I'm sorry, guys. Like, I don't have spec. The example, like, no, I'm sorry. I just don't have the spec. But you please don't educate this debate on examples. I hope structural mechanization is relatively good. But like, okay. So I'm just gonna. Responding then to CO, the first thing CO offers is they just tell us why competition is good. They give us a whole bunch of reasons why banks are stable in their consumer base and why there's therefore no competition. The high level response to this is just that obviously we still see a huge amount of competition. This is why banks have ads that are like, oh, if you're a first time person buying in, you get like $100 or whatever. This is like, there's some amount of people moving around, but also people are open to moving banks, as is obviously the case from their own anecdote about their mother wanting to move banks. The important thing is just that like, when I'm becoming 19 and trying to choose a bank, or when I'm like moving countries, there's still some amount of flow happening. So I think a lot of their mechanization, while it's quite like rhetorically nice, I don't know how well it stands up against reality. The other thing is just that they don't really explain why it is that tech companies are uniquely good at competition. I would argue not even better than what OO says, which is, they're big. The reality is just that there would be this innovation otherwise, as we characterize it to you, because of the huge incentive that there exists because of the demand. And maybe it happens slower because they're not as big, but that's a fine trade-off because they don't explain why this competition is likely to happen in the long run. They're just not sufficiently responsive to our case. Responding to OO. OO runs a whole bunch of things, and I don't really think they prove a whole bunch of, fortunately. The first thing that I want to flag is just the regulation kick in. I think OG handles this pretty well. But this like claim about like legislators versus regulators, the reality of the situation is that beyond the ineptitude of most people in government, the tech companies entering the space creates these huge legal gray areas, right? Like when a tech company is like giving out loans, but these are financed by traditional banks, like it is logistically difficult to regulate this. It is not something that just regulations will magically kick in. And in fact, 2008 showed that even if there is incentive and capacity, as O likes to say, it's not the case that this always works. I don't really understand how the regulation is the magic silver bullet here. And the second thing they push is the ease of access. Serena kind of annihilates this in like the first 30 seconds of her introduction. Holy dang, can we not weigh this debate on how long it takes me to pull the card out of my wallet? I'll just do that right now. Yeah? Okay. Not much worse. I would have spent the exact same amount of money if it was on my phone. Okay. Also the alerts. Guys, God. Okay. They then explain that banking is slow to change and there needs to be more competition and innovation. I think I responded to a slightly stronger version of this claim coming out from the CEO. But again, I don't think that they're sufficiently able to explain why tech is the unique tipping point for this competition, given there's some amount of competition that exists symmetrically. They then say, stability, because they're now too big to fail. When did I last hear that? But the important thing is that actually there's a huge amount of increased volatility, especially at the point at which you are incorporating and cross-funding between the tech and the finance sector. Because tech companies are not stable. You can see their stock just plummet immediately, and that is bad. OG flags this, but I'll deal with this. The last thing on data privacy. Guys, holy shit, I don't want to refute this. If it's the case that they're using the same data privacy as the tech companies, I'm not sure what the margin is. And I don't actually understand why this like risk of data privacy is worse than the consolidation from OG. I don't think either team is able to explain why they're winning on that front. You just ought not weigh this in the debate. Why then do we beat out over OG? OG has a couple of pushes. I think the strongest one is just their explanation of why it's the case that these companies are monopolistic and bad. But I don't think they sufficiently engage with what the actual counterfactual is because they don't explain to me, one, why there wouldn't be otherwise innovation. They just sort of say credit unions are good, but I also don't know why that's the case. It's like maybe they give like artisanal benefits or I just don't know. But then they also offer some stuff about like why ease of access is bad. I think similar to my responses to OO. And then there's something about vulnerabilities. I think they're not sufficiently unique in the way that they analyze this, right? They say that innovation could kill big companies. I don't think Google is going to get killed by like a BlackBerry resurgence, but I do think it leads to vulnerability if you're cross-funding between tech and finance. So the way we do a much better job of proving what's actually important in this debate, innovation, not the time it takes to pull out your wallet. So,
I thank you for being further. Last but not least, call upon the op-ed to close off this round of debate, and no props.
sorry.
Sorry.
Oh, sorry, completely forgot to unmute myself there. Can everyone hear me properly?
Yeah.
Also usually well, but
Cool. My speech will start in 3, 2, 1. Panel, insofar as people's finances are incredibly important to them, insofar as the access that you have to the ability to like be able to bank in a way that will ensure your future and the future of your children and generations after you, I think this is what you ought to adjudicate this debate on. Griffin tells you why people are able to access the thing that they need most, which is like this like access to like financial access to better finances, specifically the people who need it most on our side of the house. So He tells you why, like the people who are facing the rising prices from late stage capitalism, as well as the people in developing countries who have access to the internet but are in rural areas and cannot necessarily get like proper banking systems on government side of the house, like have better access to banking. I think this goes pretty much unresponded to from CG. They largely don't address how the innovations and the better access that we get on our side of the house, like they don't really address why this is not true. Okay, so I think first I'm going to talk about like front half, the few things that they address, and then I'll go into like more direct ref of each bunch. Okay. So front half talks about a few things. The first thing they do talk about is competition. I think OGPOI's DLO to ask why, like in the status quo, banking doesn't provide enough competition. They like kind of sort of answer this, but I think Griffin provides a much better answer by actually mechanizing exactly why, like these like tech firms moving into the financial sector have to innovate in order to be able to like they have to innovate in order to be able to get access to this sector. They are not just big tech firms that currently have like consumer bases that are completely like shored up and not having to do any kind of competition to get into that, given that they are moving into a new sector. I don't think that just because somebody has an Apple Watch means that they're going to go for like an Apple credit card or like an Apple banking system, especially because as Griffin tells you, the most important and proximate impact to people is their actual finances. So they are probably going to prioritize the banking system that is actually going to be most beneficial to them. I think that insofar as people have the ability to assess like what is going to be beneficial to them in this kind of way, they're not just going to be biased by things like brand loyalty, like OG wants to tell you. And also, insofar as like they are also entering this new sector, competing with not just existing banks, not just with the startups that CG wants to tell you about, but also with each other, they still have the incentive to ensure that they are actually providing the better product insofar as this is what is going to get them customers. So I think by proving that we get better competition, better like innovations, and better access to the people who actually need it, we do prove a vertical extension over OO there by actually mechanizing that, and we also take this debate over OG. Okay. The other thing that like front half wants to talk about, I'll go into direct responses to OG first. Okay, so what does OG tell you? Having already addressed the competition point, they're saying that like that the government cannot like regulate tech companies. The main reason that they give you for this is just that like Congress is like older and does not like understand big tech. I think like first of all, this is not them regulating tech companies in the tech industry. This is them regulating in the financial industry, which there is already ability to regulate. It is not just that the old congressmen that you see speaking in the video that OG refers to, like, are the ones actually doing the regulation. There are other methods of regulation. I think the government is able to regulate the financial industry, given that they have learned from the lessons of things like 2008. There are mechanisms for how to do this. But there is also like a specific willingness to regulate these big tech companies. Insofar as they are now entering a new market, it is probably going to generate news attention. The idea that Apple Wallet is a thing is something that people generally know about, and insofar as people are paying attention to it, it is likely to create some kind of political will that will lead to regulation. Okay. So yeah, I don't think the barrier to like understanding technology is going to be a barrier to actually regulating the financial sector and continuing to regulate the financial sector. Okay, the other thing that OG wants to tell you is about like competition, meaning that like yeah, the meaning the banks will engage in riskier decisions. I think they already like probably do engage in like okay, so the competition like argument kind of already takes this out because insofar as like banks are already competing with each other, already trying to undercut each other, I think the difference we provide on our side of the house that leads to better competition is like a different kind of company entering. But insofar as they are already competing, then like they are already going to be getting like accessing all of the harms of that. Okay, the other thing that OG is saying is about like the example of like Google is controlling things like access to information. So when you Google something, it's going to lead you to like their like their banking system rather than somebody else. I think like this is already kind of taken out, given that people do tend to know about banking systems. People care, people have information. People will even like hear from their friends about a banking system that is better. There are also alternatives to Google. I don't think this is true. And additionally, if somebody's bank is like bad enough, they are going to move away from it anyway. So the competition point still stands. Okay. Yeah, I'll take a POI from opening.
No one has told me why innovation is necessary or good for consumers. Which specific innovations are so vital and not just more risky or more exploitative or more profitable for shareholders?
Okay, the innovations that are good are, first of all, just like I think Griffin already tells you about this by telling you about how people are able to get better access to like the kinds of financial, like he already explains like the ways in which financial innovation works and the ways in which it is beneficial. I think like insofar as you get better financial products that help people more, this is probably going to be a benefit. We don't need to just sit here enumerating examples. Again, this is an area where like structural reasoning and the things that Griffin has already given to you actually works. Okay, so now addressing CG. They try to claim the benefits of innovation as well, but they are arguing for like a financial sector that existed not only prior to the benefits that Griffin proves, but also prior to innovations even like Google Wallet. I think insofar as the innovations that they talk about have not happened in the world that they are having to defend, they already fall out of the round. But the other thing on CG, if I can find my notes on them somewhere here. Okay. The other thing on CG is like they're saying things like that like the banking and the tech people are going to like have friction. I don't think there is a specific tipping point here. People are always going to be able to work together insofar as like working for a company means you want to work for its best interests. I think people are probably going to yeah, so proud to oppose.
Yeah, I thank the speakers for their remarks and